year. So ugly, right? All those headlines from the Wall Street Journal and Forbes and Bloomberg, and even if you like to listen to NPR as you drive around, I mean, bad news.
I'm sorry to interrupt you. I just clicked recording. Could you start from the beginning? Sorry. Thank you.
Okay, sure. Sorry, I'll go back. Okay, welcome to the myth that bonds are safe. We're just redoing this really quickly for the recording. We have a quick disclaimer that this is for educational purposes only, and nothing that I'm, no bond, no fund, nothing. I'm not recommending, I'm not discouraging, I'm just educating. And if you want to go out and buy investments, or you have investments and you want to sell them, don't do it based on what I said. Talk to an expert. Okay, so the past year, yikes, scary. The headlines were terrible. The muni bond bloodbath, and bonds, had their lowest, results since Bloomberg started measuring their bond index, and the bond index was humbled, and bond managers were, saddled with heavy losses, and all of these things. I mean, really, really shocking to see these incredibly negative headlines about bonds. Shocking to some, not shocking to me, because I had been actually waiting for this time. Sally Krawcheck, who's one of probably the most quoted women in finance, had been predicting back, I think back to 2015, a bear market in bonds, this tremendous shock. People wouldn't be ready. So, kudos, Sally Krawcheck. And I was paying attention and I was worried about it. But, and when Young asked me, what should we talk about? We were planning this investor group a year in advance. And I said, we're going to have to talk about this myth that bonds are safe, because people are going to get burned because interest rates are so low. They're bound to rise. When that happens, bond prices fall. Oh, actually, this is interesting. There's something in the chat. I'm just going to check if it's a question. I should say that if you have questions, definitely put them in the chat, because we will address them. Oh, it says, please enter your questions in the chat box. Very good, Young. Thank you for doing that. So yeah, we try to, any questions you have, we do try to cover them. Okay, so I wasn't terribly surprised, but I am concerned for people who feel that bonds are safe. That seems to be a pervasive myth that bonds are safe. So, oh, and also to add insult to injury, like here's a typical, this is, a typical brochure sheet. When someone gets a 401k at work, they get a little booklet, and I always ask people to give me copies of their booklets because I'm interested to see what they're being offered. And I was so stunned when I got this copy, a PDF from a friend who showed me this, and I was like, oh my goodness, they're putting high yield bonds in the conservative category, right? Like nothing could be nothing could be further from the truth. I mean, Bitcoin would be worse, but it's just completely false to say that high yield bonds are safe and a conservative investment. So we're going to cover all of that tonight. But in any case, to start with, what do I mean by safe? I mean, I'm thinking, when people say they ask for advice, they say, please, I want to invest, but I want it to be safe. Or if someone inherits a little money and they're like, this is all I have, I want it to be safe. Or, God forbid someone's widowed or someone goes through a divorce and they're thinking very conservatively, I don't have a lot, I want it to be safe. Very often that person, what they mean is they don't want to lose any of the principal, like they don't mind making a little money, but they would really be horrified if the principal amount, the original sum shrank. So that's what people often mean by safe. They don't want to take a lot of risk. And, for safe, you really have to look at things that are like FDIC insured, guaranteed by the government. And I would say, this is from the FDIC website, that really there are very few things that are truly safe. There's a savings account, a CD, a money market account that's covered by FDIC insurance, which is not what's going on with the brokerages, checking accounts, things like that. And they're only safe up until $250,000. Now, when it comes to treasuries, the bonds that the governments are selling, that, to a point, and we're going to get into this, is considered risk-free and safe. And so we're going to drill down into that. But there's this vast bond world that is not safe. And people need to understand, what is the risk and why? And that's kind of what we're going to cover tonight. So what I'm just going to debunk the safety myth, and we're going to talk about the interest rate risk that, you cannot escape that with bonds. The creditworthiness risk. A bond is a loan. So, just like people you would loan money to and sleep well at night, other people you'd loan money to and not sleep well at night. So, not all loans are created equal, because the borrower is, there's ranges of creditworthiness. There's fund risk. A lot of people don't understand this. They don't have the money to buy bonds directly, because kind of the minimum amount to buy a bond. I mean, this isn't true of treasuries. Treasuries, are lower, but a typical corporate bond or something, you'd have to spend at least $1,000. So people don't like to do that. So they go into bond funds. And then there's all of these risks related to being in a bond fund, because you lose control. And we'll talk about that. There's call risk, which really, maybe I shouldn't have had it on this list, but I just wanted you to know about it, because you're not at risk for losing principal because of a call risk, but you should just know about it. And then finally, I'm just going to end with good news, because we've talked about all the bad news, and there is good news. There's plenty of good news going forward. So we'll talk about that. Okay. Just to start at the very, very, very beginning, why do we even have bonds? Okay. So let's be clear. There are initial public offerings of stocks, and there are offerings of bonds, because, in companies, like publicly traded companies, can either issue stock, they can go the public route, become publicly traded, issue stock, they're raising money. They can also issue bonds, they're borrowing money, but in either case, they are raising money. So stocks and bonds exist to raise money. Now, there are some key differences. A municipality, a town, is not going to issue stock. You can't have part ownership in a town, right? So there are key differences between stocks and bonds. Stocks indicate you have part ownership, right? So if you own Disney stock, you have part ownership in Disney. And so you're you're along for the ride on how that business is going to operate and be profitable. And you hope that they're going to have earnings and plenty of earnings, and then your stock price will go up. And that's kind of how that works. On the bond side, it's just a loan, right? So loans are very structured, and they're kind of boring, right? I mean, it's a loan usually at a certain amount for a certain sum, and a certain duration, a certain length of time, and a certain defined yield. Okay, so this is you're just giving a loan, and it's like, say it's for 2 years at 6%, or it's at 5 years at 3%. And this isn't very complicated. It's usually very structured and very straightforward. So stocks, you can also make money on a periodic basis because they have dividends. That's a story for another time. But in any case, you have companies out there issuing stocks, issuing bonds to raise money. But then the bond market is huge, because municipalities, governments, they can't issue stock, but they certainly can ask for a loan, so they can issue bonds. And there are all these entities that you might not have thought of. Like, I actually put Babson College up there, because maybe people aren't even thinking how colleges are entities where they borrow money. Maybe they want to build a new football stadium or whatever, and they don't want to rely on just current tuition payments. So they're credit worthy, and they go out in the bond market and they borrow money to do something big and lavish at their school if they haven't been able to just raise money for it. So there are all these entities out there that are borrowing money, and it's just how they're raising money. Okay, so the first thing we said we were going to debunk is the safety myth about bonds, because there's what we learned this year, huge interest rate risk. And when interest rates rise, bond prices fall. And this has been an inverse relationship forever. Anyone who goes into investing should know this, but we've had 40 years of not having to think about it. And that's why it's a problem. So when anyone interested in investing must understand how bonds are impacted by interest rates. And I'm just going to give you hopefully this example makes sense. I'm going to pause 1 second because there is a question in the chat. Okay, let's see. The recording will be posted. Oh, okay. So this is about the recording. Okay, everybody knows this is being recorded. All right, so we've had 40 years of the good old days, okay? This is why people think bonds are safe, because we've had 40 years of falling interest rates. Some of you listening, you're not even 40 years old. So just trust me, you have to go back to the 70s. I was a kid in the 70s. I remember being in my Aunt Annie's car, online to get gas. Lots of things were screwed up in the 70s. And one of them was super, super high interest rates, terrible inflation, all these problems. So you had unbelievably high interest rates. And then we've, since that was sort of what we inherited from the 1970s. And then starting in the 80s, everything got better, everything started to calm down and rates started to fall. Well, when interest rates fall, the people holding bonds make money because bond prices rise. So this is sort of how in the good old days, which lasted for 40 years, this is how things work. You were holding a bond, right? And I just made this up. I didn't go back historically. I kind of tried, but I couldn't find it. Did Starbucks issue bonds at any point like this? But let's pretend they did. It would be a fine example. So, Starbucks wants to raise money and they decide to start issuing bonds, and you could buy.
We're not adding 440 cars. Right now there's 200 cars effectively that park on the site. When it was in full operation, existing configuration, there was, busing.
Oh, I don't think that person's asking a question. Young, can you mute him? Okay, thank you. Okay, anyway, so, say you're willing to lend money to Starbucks. They want to raise money, open more stores, whatever. And, interest rates are falling. So you loan the money at 5% interest per year. You get 5% per year for 10 years. That's the deal. That's the bond. Well, then interest rates are falling and falling and falling. So now, a year or two later, when the new bonds come out, when it's usually a different company, but let's just say it's Starbucks. Now they go out in the marketplace, they want to raise more money. And the best they can do is, they're just going to offer 3% because rates have fallen and they don't have to offer 5% anymore to borrow money. They can just offer 3%. Well, that's not such a great deal for the people buying new, but it's a great deal for you if you're sitting on these old bonds where your bonds are paying out 5% over 10 years. And this is pretty simple math, right? So if you borrowed $1,000, 5% of $1,000 is $50, and you multiply that by 10, like that's $500. So at the end of the life of this bond, you will get your principal back. So you'll get the first $1,000, and you'll get this 5%, that happened every year. Sometimes you get paid every 6 months, sometimes it's once a year, but in any case, you were making your $50 every year because that's the 5% on your original 1,000. So you were getting $50 every year. And then at the end of the 10 years, you get your $1,000 back. So now you have, you have $1,500. That's great. But these new people, over the life of their loan, they're making 3%. So they're just going to get $30 a year. And after 10 years, that's $300. So one bond would have given you $1,500 total when you put in 1,000. Another bond gives you $1,300 total when you put in 1,000. So obviously these newer bonds are of less value. Well, that wouldn't make any difference if every time someone bought a bond, they held it to maturity and it was just locked in. Like if there was no secondary market, if there was no way to sell a bond that you were sitting on, right? Then none of this would really matter. But there is a secondary market, just the same way that when you're watching, ticker symbols and stocks, that's all the secondary market, right? There's initial public offering and very few people participate. But then the stock market that we watch every day, that's a secondary market. Those shares are being traded back and forth among individual investors and institutions and things like that. So with bonds, there's a secondary market. So there were these initial offerings, but then people don't just sit on their bonds. Institutions don't just sit on their bonds. They, for whatever reason, want to sell them or they want to buy new or whatever. And because of this resale, because of this secondary market, when bond prices were higher and people are sitting on bonds that have a high yield, they're in a great position because they own a bond that's considered more valuable because it has this better payout. The newer purchasers they can't get access to bonds with good payouts. So one thing they choose to do is look at the bondholders who have the better payout, and they say, hey, I'll pay a premium. I'll take over the life of your bond and I'll pay you a premium for it because it has this value. So when interest rates are falling, that's why bond prices go up, because the older bonds have more value. They have a better yield. And this has been going on, this dynamic is a 40-year trend. Now, I'm not sure if you can see this, but I'm starting this graph at 1982. And the interest rate, this is a 10-year. So this is what 10-year treasuries, so this is the government, getting loans. This is what the government was paying in 1982 to borrow money for 10 years. They were offering 15%, unthinkable today, right? 15% a year for 10 years just to borrow money. We haven't seen anything like that in, I don't know, 3 decades. Almost 4 decades. Yeah. I mean, the last time we saw that was 1985. Okay, but so we're starting this at 1982, and then rates are coming down, 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 down. The early 2000s, they're just kind of going sideways, but sideways isn't up, right? So there was no loss of money. Bond prices were never falling, really, truly, until recently, because you had this 40-year trend of declining interest rates. Okay, well, investors spent a lifetime enjoying these declining rates, or at least sideways rates, right? So they got used to this idea that bonds are safe because they never had that situation, which is the new reality of the last 2 years. This is not fun. This is not good. Well, I mean, it's great for other reasons, but this rising interest rate environment, if you are sitting on a bunch of bonds, you are not having a good time, because now bond prices fall when interest rates rise. So now you're imagining the other scenario of these people, they're sitting on their bond that's only paying a 3% yield. And all these people can go out into the marketplace now and they can get a bond that is a 5% yield, right? So the life of their bond over 10 years is only going to pay out this $300 in interest, and people buying new over 10 years can get a bond that's going to pay $500 in interest. And they're like, well, there's no resale value for the older bonds, right? But there's this secondary market. So people want to be able to be liquid and sell their old bonds. Well, the only way they can do that is if they discount the bond, right? So that's what they mean when bond prices fall. Like, no one's going to give $1,000 for a bond that's locked into a 3% rate when they can get a 5% rate. So what happens is that principal amount gets discounted. It gets shrunk down. Somebody else does the math to kind of figure out how to make this equivalent. Like, how low do you have to make that original face value price, that original $1,000? How low does it have to go to be equivalent of the 5% yield? And that's what the discounting is. And that's why bond prices fall in this secondary market. Now, very importantly, this has nothing to do with a bond if you hold it to maturity, right? If you're holding it to maturity, then that doesn't happen. And so we're going to talk about that, but this is this secondary market. If you want to sell your bond, not hold it for 10 years, or all these bonds are in a bond fund where you don't even have control of whether they're bought or sold, it's a real problem. And this is how you lose money in bonds when interest rates are rising. That's just how that works. And people didn't have to think about it. People got used to thinking the opposite, because for 40 years, it's been the opposite. Okay, so that's the interest rate risk. Now we have creditworthiness risk, right? So just like you, right? Just like you, bonds have a credit score. Not all borrowers are created equal. That's just common sense, right? A thriving company with great earnings, with very low debt to begin with great prospects, is not the same as a struggling company, with already has a lot of debt. I mean, there are all these different things that go into, your credit score, how much, how good you've been about paying your bills, how much debt you're already in, how much income you happen to have. I mean, when someone, when these credit agencies like TransUnion, Equifax, and Experian decide your credit score, it's not dissimilar to the way that these big rating agencies decide how to rate a bond. So there are three big rating agencies. There's Moody's, Standard & Poor's, and Fitch. And I was just going to cover Moody's because, they're so similar, it doesn't even matter. But here is, a typical, these are the top ways you can rate a bond, right? I mean, I think there are 26 different ratings, but I started at the top. So here are the top 5. Something can be AAA rated. And it's just, that is like the highest quality. There's minimal risk. So, I don't know, name some fabulous company. What's some company we all love? Like Apple. I'm sure Apple, I don't even know if they offer bonds, but if they did, they would be AAA rated. But then it goes down from there, right? And it's really important, to notice, and certainly if you're going to be buying individual bonds, you better be checking out their bond rating, because it starts to deteriorate. The creditworthiness starts to deteriorate. And these are the top 5, and I think there are 26. So even just, you get down to the 5th level, the BA level, and it says, kind of speculative if you're going to lend these people money, and substantial credit risk, and that you're still in the top 5, and they're saying it's substantial credit risk. So they're talking about default, right? Now, default doesn't mean 0. Default doesn't mean you won't ever see any money again, but default does mean that they could have that whoever you're borrowing from, whether it's a municipality or a business, they could struggle to pay back. Maybe they'll miss interest payments. Maybe they can't return the entire principal. Like, default is a very broad category, but it just means like whatever the original deal was, that is not happening, and that's bad. Okay, so that's your credit risk. Now, it's really, really important. I'm showing you the top 5 levels that Moody's does. It goes down from there. So anything below what I just showed you, those are called junk bonds. Now, junk bonds are not necessarily bad. In fact, Mike Milken, I could talk, for 20 minutes just about Mike Milken and what an innovator he was. He's kind of like the father of the junk bonds. And it was, some people think of him as a criminal. I think of you as kind of cool, like kind of smart, and really opened up the bond market to, maybe a casino is not, worthy. A casino is a decent business in a sense, but the old bond types didn't want to lend to a casino because it was kind of like thought of as lowbrow. Well, Mike Milken didn't care. He's like, if they've got a good balance sheet, if they're a good business, like, why not lend them money? So he really broadened, the bonds going out to different corporations. In any case, some people don't understand, like my dear friend who, in her brochure for her 401k, she's looking at this. Actually, I got to show this again because it really blows my mind. Let's go back to this brochure, someone's 401k, highly reputable company. And she gets this thing that says, okay, as you're picking your 401k investments, do you want to be conservative, meaning safe, or do you want to be more aggressive, right? So she's looking at this and it says high yield, like high yield bonds, Invesco high yield fund bonds, right? That should never, ever have been put on the conservative side of any slide, any brochure, anything. High yield, those are junk bonds. We've just talked about this. That's like terrible creditworthiness, okay? Like really not investment grade creditworthiness. And I don't know who created that brochure, but they, that's crazy. And no surprise that over 5 years, right? So imagine you've been putting money into your 401k and you really tried to be careful and you went into this high yield fund thinking bonds are safe. You've lost 17% while the broader stock market has gained 42%. I mean, that's just terrible. And in this case, I'm only talking about prices, right? So I'm not talking about whether the high yield fund was paying out. I'm sure they were paying out, interest payments, and I'm sure, but also the market was paying out dividend payments. So, but just based on price, you've got a decline of 17% versus a gain of 42%. And almost anybody who knows anything about investing would have said that investing in the S&P 500 is kind of on a par with a high yield bond fund, or maybe better than a high yield bond fund. High yield means not investment grade. Okay, so hopefully now we've covered two very important, interest rate risk. If interest rates are going to continue to go up, then anyone sitting on bonds is going to continue to lose money if they don't hold to maturity. It's all about the secondary market. And a creditworthiness risk. People are getting into bonds, getting into bond funds. They're being called high yield, which sounds like, hey, yeah, I would like some high yield. But they're not understanding, connecting the dots, that means that the creditworthiness of the high yield means junk bonds, right? Like they are not investment grade. Doesn't mean you shouldn't do it, means you should understand the risks. Okay, so, all right, so we did that, we did junk bonds. Now, and please, if you have any questions, put them in the chat. Happy to stop, happy to answer questions. So what do I mean by fund risk, right? Like everybody tells you mutual funds are sleepy and safe and don't worry about it. And this is how you get diversification. And if you don't have a lot of money to invest, this is how like you could put $50 every month into a nice little mutual fund. And that is all true. And I am not trying to knock mutual funds. But if you've been paying attention to what we've said, especially about interest rate risk, then this loss of control, like if, bond prices are falling because interest rates are rising, you don't actually have to lose any money if you own the bond outright and you're just sitting on it. You're just like, I own one bond, several bonds, you're going to hold them to maturity. They're very high investment grade. You're not worried about default. Then you have no problem, right? But when you are in a mutual fund, you are not in control. So in a mutual fund, the fund manager is in control. So here are the things that can go wrong inside a mutual fund. The fund manager sells the underlying bonds for a loss. And you might say to yourself, why on earth would he do that? Like, why wouldn't he just hold to maturity? Because I was willing to hold to maturity. Why wouldn't he hold to maturity? Well, that's a good question. But one reason that came up recently, people started to panic about losses in bonds. And so they started demanding their money back from mutual funds. And when there are fund outflows, the person who manages the fund has to give people their money back. If people are panicking, he has to give people their money back. But he doesn't have any cash because the whole point of his fund is to be fully invested in bonds. So now he has to start selling in order to give people their money back. And he has to sell for a loss because everything he's sitting on is at a loss right now because interest rates have run up so quickly that, there's nothing that a fund manager could do, he or she, to get ahead of it. So that's the problem, one problem with mutual funds. You might also get a fund manager who thinks, I can dump some of this stuff now and buy better stuff later. I mean, hopefully they're not trying to time the market, but they might be. In any case, you don't have control. So there can be losses. There could also be, tax consequences that you personally are not expecting. And it's a little confusing to me how there could still be, and again, this could just be poor management, that someone doesn't manage the, if there were bonds that had made money and they got sold and there was a gain, then, and if there was a gain for the fund overall, that creates a tax consequence. And, you're not controlling the tax consequence because you're not in control of the buying and selling. So taxes are essential to understanding investing. And you absolutely, absolutely have to understand your tax bracket. And you have to understand long-term gains versus short-term gains. So if any of this is new to you, you should definitely watch the tax consequences of investing, which is one of the ones we already did, and it's on YouTube. And I always offer the taxes 101 chapter of my book. I just give it away for free as a PDF. So if you email me, I'll give it to you. But again, in mutual funds, you're not controlling the buying and selling, so you're not controlling the tax consequences. And the last thing that's really kind of creepy is that there are plenty of mutual funds out there that say we're safe, we only invest in government bonds. And people take that to mean that it's, these are these treasuries, these are these bonds that are being issued that are definitely backed by the full faith and credit of the US government. But that's not what the fund means. I mean, there are these agencies, these kind of government agencies, especially the mortgage-backed security agencies that they're sort of government adjacent. I mean, they're government, but they are not backed. They are not backed the way the treasuries are. So I hope we never have to deal with that. I hope that sounds like kind of scary, but like, don't think because you're going to a mutual fund that's supposed to be like government debt, that it's guaranteed, that the principal is guaranteed, because that's not true. Okay, so great quote in Forbes saying that this is a fascinating detail that is not well understood by investors. When owned directly, these bonds are owned directly, not in a mutual fund, investors can hold individual bonds to maturity. So you've gotten rid of the interest rate risk because you're not trying to resell on the secondary market. You've gotten rid of, for whatever reason, having to sell at a loss because there are bond outflows. So, an investor has control and discretion to eliminate the effects of rising rates by holding the bond until it matures, at which time the principal is paid in full. A fund, meanwhile, because it is commingled among many investors, cannot do this for each investor. So those investors are left to buy and sell those funds without knowledge of the underlying maturities. So you just lose control if you're in a bond fund. Okay, and again, like I said, anybody can email me, kjax@moneyinyour20s.com, and I'd be happy to give you this free chapter, Taxes 101. You really cannot be a competent investor if you don't understand our progressive tax system. If you can't tell me today, like what tax bracket you're in, you need to read this chapter. Anybody who invests should know their tax bracket off the top of their head. Okay, call risk. Call risk it doesn't really run afoul of this safety thing, because I said safety means you're not gonna lose your principal and blah, blah. So call risk has nothing to do with losing the principal amount. I just kind of threw it in here because as you're listening to this, if you're thinking, okay, I got it, especially if you have the money, like I got it, I have the money, I'm only gonna buy bonds directly from high quality, issuers, and therefore I'm in the driver's seat. I control. There's not going to be a default. I'm not going to need the secondary market to buy this bond for me. If interest rates go up, I don't care because I'm holding it to maturity. So you think, hey, I got this, and that's what a lot of people think, and that makes so much sense. And it can work, right? I'm not going to tell you how it can work because I really don't want to get into telling you what to invest in, because that's, but you can find the registered investment advisor out there who specializes in bonds to help you do this and keep you, out of trouble. But there's this thing called call risk, where the companies that issue these bonds, they are in the driver's seat because they can call the bond. So right now, say bonds are paying, 5 or 6%. Well, interest rates have been going up, up, up. People kind of think they're going to continue to go up, but nobody knows. Well, what if they go down? I mean, what if all of a sudden we return to these rates, from what if they go down to 2%? I mean, anything could happen, really. I mean, we've had low interest rates for so long, maybe we're going to return to that. So now all of these people that issued bonds, they don't want to keep paying 5%, because if they had the opportunity to pull those bonds back, they could reissue new bonds at a lower rate. Well, that's exactly what they do, because as they're selling bonds, they put call provisions into these bonds. And the call provision means if we want to, we can repay this bond at any time. We can call it. A lot of people don't know that. So they think they get their bond ladder together. They think they've got it all figured out. And they're like, okay, great. I've got it all structured. So I know, what bonds I'm buying. I know they're paying a good rate. I'm going to plan to hold them to maturity so I can sleep at night. I'm in the driver's seat, set it and forget it. But it doesn't work that way because corporations can just call and say, we're giving you your money back. So you get your money back. It's not a safety issue like a default. But they're like, yeah, we said we were going to do this for 10 years, pay you 5% a year. We're not going to do that because interest rates have gone down again. So why would we? Here's all your money back. Thank you for playing. So David Swensen, who is the legendary manager of the Yale Endowment, passed away in 2021, sadly, not of COVID. He had cancer for years. Actually, his life got extended. They did everything they could. Terrific guy. His books are amazing. If you're really, really interested in being, your own investor, then I would read his book, The Unconventional Success. Fantastic. And this quote is actually from Unconventional Success and talks about how, it's this heads you win, tails I lose situation where you line up all your bonds, but then the corporations are really in charge. And if rates go down, they just call the bond because they can, and they give you your money back. So you really don't have the control. And I'm not going to tell you how to fix this situation because I really, to protect myself, to protect the library, I'm not dispensing investment advice. I'm just educating. And so I'm giving you a heads up, and then you can find the experts out there that will help you fix this problem. And there is a workaround. Okay, so I've said a lot of, not so great things about bonds, but the bond market is huge. Bonds have their place. There are definitely, you can't put your money under your mattress. Stocks are risky. So there is some good news. There is definitely some good news. And PIMCO, a huge bond company, very famous, maybe not famous to people who are just getting into bonds, but very famous. And so their chief investment officer, and you can go to the PIMCO website and watch all these really cool videos about forecasting in the future and things like that. But he's saying, at the end of the day, now that rates have gone up, what the future bond investor has to look forward to is that bonds are actually finally returning some good yield, because for years in a super low interest rate environment, you couldn't make any money on your money, right? You took it to the bank, the bank didn't pay anything for savings, the bank didn't pay anything for CDs. You try to buy a bond, the bonds didn't pay anything. So now in this rising interest rate environment, you actually have a place to park your money where you can get 5%, right? I mean, the short-term treasuries are paying extraordinary amounts. Like it's unbelievable. What is it? I think the 3-month treasury is above 4% right now. So, you could actually park your money in safe places and make a good yield. So that's the good news. It's bad news if you've been sitting on a lot of bonds. You're the loser in this situation. But for people who are just starting out, and maybe that's why you're listening to this, because you're interested in moving forward, you really can get some good yield off of your bonds. Now, everything I said tonight is very complicated and hard to digest, but we do have 20 minutes left. It's only 7:40. I have to leave at exactly 8 on the dot, but I am happy to answer any questions. And I'm going to go back to basically sort of what we said we would talk about. Okay, so this is what we talked about. There's interest rate risk, creditworthiness risk, fund risk, call risk, and then good news. Any questions? You can unmute.
Kristen, could I ask you?
Sure, Phyllis, go ahead.
I've lost money on corporate bonds that the business is still operating. And that was, to me, very surprising, misleading, deceptive. I just didn't get it. So these corporate bonds.
You mean they defaulted, or you just lost money because you were in a bond fund and it was sold?
No, I wasn't in a bond fund. No, I owned that particular. So one of them is Boston Market, which is still operating, but it stopped paying. This is going back a number of years. So I just thought maybe you could explain a little more about corporate bonds and how they can.
Oh, sure. Yeah. Oh, that is a great question. Thank you for bringing this up, because for a variety of reasons, and some of them are really good. If you take like a Boston market, right? I think a lot of people know what Boston market is. So they're operating their business, they're selling bonds to raise money. They probably at the time had a good credit rating. I don't know who put you in this bond, but maybe they did the right thing at the time. And maybe the credit, I'm assuming the credit quality deteriorated. And so there was some either level of default, or I don't know if the bond went to zero. I mean, if there was a bankruptcy, if we have 30 people listening, if someone else knows exactly what happened to Boston market, chime in. If they went into bankruptcy, that could be really severe. But like in bankruptcy, then the bondholders don't necessarily get zero, but there's, all this stuff that goes on of like looking at like what is viable for this business, how could they continue to operate, and sometimes the bondholders get like really pennies on the dollar, and there's a whole process, a sort of distressed debt process. And if anyone listening is an expert, please chime in, but it's definitely very jarring that a company, you lent the money and they're not going to pay you back the full amount, that they're going to be in default. And how bad it gets is going to be sort of how bad the bankruptcy is and how bad their future is. And, if the company gets completely liquidated, but sure, it happens, I mean, there's a whole distressed debt universe, and it's interesting what happens to them. I mean, the worst case scenario, I guess, is like an Enron or a WorldCom, or I don't know if people saw any money when those companies, especially Enron, because it was pure fraud. But this is what happens. And this is why these credit rating agencies exist, because they're supposed to be sort of foretelling which companies could be bad. So when you were put into Boston market, at the time, hopefully whoever did that to you, for you, whatever, there was good credit quality, and maybe the credit quality deteriorated. And that sometimes you'll see like on news channels, financial news channels, they'll say there's been a downgrade, like Moody's has come out or S&P has come out and downgraded, a certain company. And what they're talking about is they've downgraded the creditworthiness of that company. And so now that company is not such a good candidate for borrowing money. And this is this whole high yield universe, right? As companies get downgraded, it doesn't mean they can't borrow money. Maybe they go into the high yield universe, and we seem to have ample, institutions and people still willing to participate and lend money to companies that aren't as creditworthy. But I can research this. If you want to email me later, I'd be happy to research what happened to Boston market. But I'm just have to guess that their business declined and they had to start defaulting on their bonds, and that's what happens with distressed debt. Okay, let's see.
You can understand if a company goes belly up and goes out of business, you're not going to get your money.
Right. Well, I mean, or you get some of your money, because if a company goes, into bankruptcy, it doesn't mean you get zero. I mean, or maybe you know more about this than I do, but I thought, then there's that whole process of what are they going to pay the bondholders? Whoever that was who just talked. I mean, I think that's, that default does not mean zero, but it definitely means pain. So, and how bad is the pain going to be? And, that it's interesting. I wish I had thought of that. I could have taken up, I could have done like a few case studies of like, some defaults and like maybe like a not so bad one and a terrible one. And, but you hear about these things of like paying 65 cents on the dollar and things like that. And it's better for bondholders than for stock owners. I mean, the bondholders come first in any kind of bankruptcy, and so once you're in bankruptcy, usually it's like the shareholder is going to get zero. So you kind of wonder why like Bed Bath & Beyond is going into bankruptcy and people are still trading the stock, and it still has some life to it. And I'm thinking, what is going on? But that's a real stretch to think that there's, they're going to see anything, once the bondholders are made whole. Okay, well, we do have more time. Questions, please. All right, I'm not sure I made it to the last, let's see. Okay, how do taxes relate to bond yields? Okay, that's a great question. So my understanding is, like when you get dividends paid from a company, that just gets taxed as normal income. My understanding is that when you get income from bonds, that's taxed as normal income unless you've purchased a bond that's kind of has the special tax, like munis, like there are certain bonds people purchase because there's a tax benefit sort of prearranged, like municipal bonds, certain municipal bonds, and people normally think it's all, but it's certain municipal bonds. You don't pay federal tax, and very often you don't pay your state tax. So munis meaning like a municipality, right? So some town has issued a bond, has borrowed money, and because they get special tax treatment, then you don't pay any tax on having, when you get those coupon payments. So a coupon, I mean, I haven't done this in a while. So like coupon is like what you get paid, that's your interest payment. So, if they're paying it every 6 months and it's 5%, you're getting your 5%. So that's your coupon payment. Let me see if someone's correcting me here, because hopefully I'm not slaughtering this. How do taxes relate to bonds? Is there a federal tax on treasury bonds? Okay, see, that's a great question, because there are different bonds that are federal government issues where some get taxed and some don't. The typical ones do get taxed. But then I think it's E series or EEE series. There's certain bonds that you can buy from the government that don't get taxed. And that's a great question for a tax expert. But in any case, taxes are always a huge part of investing. And so you definitely want to know what you're getting yourself into. But of course, if you're buying anything, a bond fund inside your 401k, inside your IRA, not a Roth IRA, your regular IRA, don't worry about it, because there are no tax consequences until much later when you start taking your required minimum distributions. But if you're buying outside of a 401k or an IRA, and you're buying bonds directly, then yeah, you do have to kind of question what the tax consequences are. And so people who are in very, very high tax brackets, and again, this is why you have to know your tax bracket, and you have to know how tax brackets work. And if you don't, I will be happy to send you the chapter of my book. But if you're at a very, very high tax bracket, those are the people who look for these bonds that have different tax consequences than a regular bond. I hope that answers your question. I don't know that did I go to the very last slide to make sure that you know about our next? Okay, all right, want to make sure you know about the next webinar in February 7th, which is all about real estate and investing in real estate. And we're definitely going to focus on, like, even if you don't have a lot of money, right? Like if you wanted to have a low amount, what can you get into for a low amount? Or even things like, instead of taking money and investing it, right? Like when you take money and you invest it because you hope for a certain return, if you can eliminate your mortgage insurance and you can eliminate that payment, that might give a better return, a better bang for your buck than the normal kind of investing that you're planning to do. So these are the sort of things that we're going to talk about, and whether or not you should sell your house, right? Lots of things related to real estate, and hopefully they eliminate the PMI. Things like that are kind of new ideas that are like, oh, I hadn't thought of that. But really, in an environment where a lot of the banks are saying they'd be surprised, a lot of the forecasts for the stock market are not so great, between 4% and 7% this year. Bonds, we'll see. So maybe the best thing you could do with your money is to save money in ways that you hadn't thought about. So one of my favorites is to eliminate your mortgage insurance in case you hadn't thought about it. So join us for that on February 7th. And then again, if you want to email me, kjax@moneyinyour20s.com. Follow me on Instagram if you are wondering when my next webinar is, or you just like little tidbits of information. Yeah, so I think that is it. I don't see any more questions in the chat, but this has been great. I thank the library
If no
Great.
more questions, we can end earlier. Just want to remind everyone that after the recording is made, I'll send the recording to everyone who registered. So it's very important that you register for the program. Even if you have, scheduled conflicts, cannot attend the program, we can, but you register, I have your email address, I can still send the video to your email. And also all the previous recording are on Greenwich Library's YouTube channel. So if you go to youtube.com and in YouTube, you search by Greenwich Library, you will see all Kristen's previous recording online. Thank you, Kristen, and thank you everyone for coming.
Oh, wait 1 second. B, did you have a question? Because I see you kind of like unmuted yourself.
Me?
Oh, there was a person who unmuted
Oh.
themselves.
Yes, so hi, Kristen.
Hi.
No, but maybe it's I bought US Treasury bond. And I'm a little confused in terminology with the word coupon and rates and yield.
Yes, yeah.
Because the yield
So-
was like 3.5 and now it's like 4%, but suddenly I thought what's going on with the coupon, and I don't understand.
Great question. So a long time ago, when everything was paper, you bought a bond, it actually had these coupons that you tore off. So it was like how they were going to make you the payments, or at least this is what I was told, I mean, this was before I was born, but like the coupon, the reason that they'll talk about like the yield or the interest payment is the coupon is just kind of this old fashioned language that was connected to bonds when they were paper. And I don't know who tore off what, but in any case, when you were getting that payment every 6 months, that little coupon was what it was called. But it's basically your payment, right? So if you bought a bond and it's paying 4% and they pay out every 6 months, so you're getting, that, I guess, 2% every 6 months or 4% if it's only once a year. So that's what the coupon is. The yield is whatever the bond is paying. So if your initial amount was, you're buying $1,000 bond and they're saying, the coupon is 5%, that's the same. The reason it gets confusing, it's pretty much the same. Like if you hold a bond to maturity, then the yield is what you agreed upon, what they said they would pay you initially. The reason it changes is in this secondary market, right? So when interest rates are either going up or going down, then the yield is different than the initial coupon payment of the bond. And this is confusing, but you can imagine like someone has a bond, they give $1,000. Now interest rates have gone up dramatically, right? So these older bonds are not as attractive because they're paying low rates. So that first, you say it's $1,000 plus 3% is the coupon. Well, as rates rise and the new bonds are like, you pay $1,000, you get 6%. When that old coupon of 3% is like yicky, like nobody wants that. So the only reason somebody would buy that bond is that $1,000, which is the face value of the bond, is going to shrink. Okay, and someone's going to pay. They're not going to pay $1,000 for that bond. So, and this is where we really get into the math. Different people do this math. So they say, okay, if someone's going to buy those old bonds, looking at what they could get in the market today, what they're really going to do is say they pay like $880 for what used to be a $1,000 bond, because what they're trying to get is the same yield. So, and this is what the math people do, right? So if you have like an old bond that only paid 3%, the new bonds pay 5%, they kind of solve for X to figure out what that original principal, that face value, needs to shrink to get the equivalent yield. I don't know if that makes any sense.
Thank you, Kristen. I have a lot of work to do.
It's confusing, but this is like, when bond prices move around, it's really just to try to make, whatever the interest rate has done, however it's impacted the bond, then the face value is going to either go up or down. So if interest rates are going up, the face value, what you can sell it for is going to go down. And then, but I don't know, it's hard. I mean, I don't know if that's helpful. All right, I did say I only had 3 minutes left because I have to race to get my kid at diving, But let me see, there's one question left in the chat. Oh, it's a
No,
thank
that's
you.
the, yeah.
Thank you. Thank everybody. This is great. I love doing this. And I hope it helps.
Thank you so much. Mhm.
Okay.
All
Okay,
right,
thank you,
everyone.
Kristen.
Have a great night.
And thank you everyone
Good
for
night.
coming.
Mhm.
Okay,
Bye.
bye. Good night.
Bye-bye. Good night.